Hello there, so today's video is about EPR Properties. The Q 2020 results are out, so the first of the three things I'm going to go through with you is an overview of the 2020 Q4 results, and we'll see how they did, what they've been up to. The second thing is we're going to talk about the dividend, when that's likely to be reinstated. Those of you who follow this channel will know that it's a monthly dividend. If you follow EPR Properties, you know it usually did a monthly dividend, but it's currently suspended. And the third thing I'm going to do is I'm going to let you know if I'd be buying, selling or holding this stock based on its current share price. Now, if you're new to this channel, welcome. My name's Andy, and on this channel I talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you'll get notified every time I release a new video. And if you enjoy this and find it useful, please do remember to hit that thumbs up, because it helps the YouTube algorithm, which in turn helps me, and I do appreciate it. So without any further ado, we're going to head straight over to the slides. So let's have a look at the screen. I'm going to be taking you through the investor presentation from February 2021, as you can see now. So key things to note here. Q4 collections were 46% of pre-COVID contractual cash revenue, compared to Q3 at 43% and Q2 at 29%. So it is getting better, but still they're collecting less than half of what they're due to be collecting. So personally, I don't see that as a particularly great thing, but at least it's moving in the right direction. Now, January collections were 66%, February collections up to 24th were 64%, so about the same as January, all said and done. Now then, there's this next section here, deferral agreements. They've addressed approximately 95% of pre-COVID contractual cash revenue, that's good, but they've granted 5% permanent rent and interest deductions. So they've basically deducted what they were going to be earning by 5%. So that's given away essentially forever, as far as I can tell. Properties reopenings, well, you've got theatres, 60% of the theatres are open, but bear in mind they're all running at reduced capacity of those that are open. With the vaccine rollout, major releases will accelerate in the back half of 2021, and I agree with that. I think, you know, theatres will have a good end to 2021, providing the vaccine does what it's meant to do. Non-theatre properties, apparently 94% of non-theatre properties are open. Now notice that the percentage of properties open is much higher than the percentage of the rents being collected. Now, me personally, I am a landlord, and I can tell you now I've had 100% rent collection. So they are not doing as well as, say, I'm doing. Now, I admit their tenants are obviously not as robust as my tenants, quite clearly. It is a concern still, and obviously we need for their tenants to do well and to actually get paying those rents and get caught up on the rent outstanding, really, if we're hoping for the dividend to be reinstated. But let's have a little look a little bit more. So return to growth. This is what they're hoping for, their key requirements. Improve and stabilise cash collection, exit existing debt covenant waivers, reinstitute the monthly common dividend. Notice they've actually said there they intend to reinstate the monthly dividend, so that's good. Reinitiate the investment spending, because obviously that's all been on hold. And when will that happen? Well, their timing is dependent on many variables, including an effective vaccine deployment, but they are optimistic that these goals are achievable during the second half of 2021. Remember that? That's an important little note. I actually want to show you this section now of their earnings call, because again they mention dividends here. So as the country begins the recovery process, we look forward to getting back on the path to growth. This process requires continued improvement and stabilisation of our cash collections, which will allow us to exit our existing debt covenant waivers. Upon achieving that goal, our focus will return to reinstituting our common dividend and reinitiating our investment spending programme. The timing of achieving these milestones highly dependent on a number of variables, including an effective vaccine deployment. However, as today's results indicate, our progress has measurably improved in the early months of 2021, and we are optimistic that our goals are achievable during the second half of 2021. So again, they're talking about the second half of 2021. So don't expect the dividends to restart anytime, I would say, before July, obviously July being the beginning of the second half, and it might be a little bit later. It might be October, November, December. But remember, if they make a profit, they have to pay a percentage of that as dividends. We're going to go on to what profit they have or haven't made in a moment. So let's carry on with the slides. Now I want to show you this slide purely really to point out that 47% of their cash revenue comes from theatres. So almost half of the revenue for this company comes from theatres. And that's why it's so interlinked with how well the theatre industry is doing. And that's why when AMC basically announced that they were okay and weren't going to go bankrupt because they've raised more capital that should hopefully see them through. So they're hopefully out of the danger zone. Although, of course, bear in mind that could all still go wrong. But at the moment, it's looking okay. Touch wood. So providing that stays good. But you'll notice that when AMC share price increased, so did EPR Properties share price. And that's because AMC Theatres is EPR Properties' largest tenant. Now, if you've watched my previous videos, you'll know that already. And I spoke about what would have happened if AMC had have gone into liquidation. If you're interested in knowing more about that, I'm not going to go through it all in detail again now. I've got a whole playlist of EPR Properties videos. I'll put a link up there and in the description down below. Feel free to check those out and find out a little bit more about this company if you're new to the company. If you're one of my regular viewers, you'll know all this already, so there's no point in me repeating it now. So the theatre segment, as you can see, they've got 17 operators, and as I said, makes up 47% of their contractual cash revenue. And you'll see they are still very bullish on the theatre segment. In one of my previous videos, I believe I spoke about AMC, and I actually showed a graph showing the launch of Netflix, Hulu, Prime Video, Disney Plus, all of those things. They have not negatively impacted theatres as you might expect, and theatre growth attendance has done very well. And the bottom right hand side, that little graph there, really that just shows, you know, the popularity of cinemas when compared to other forms of entertainment such as Major League Sports or theme parks. As you can see, the ticket sales are far higher for cinemas. So it's still a very popular thing to do, and that's been growing. And this is one of the reasons they're expecting it to grow in late 2021, because there's pent up supply. There's a lot of movies that haven't been released yet that will be released to the cinema. And obviously, if you've watched the AT&T videos, you know a lot of theirs will actually be going direct to HBO Max and to the cinema theatres at the same time. So it'll be interesting to see how that affects things. But the fact of the matter is there's going to be a lot of releases in the late half of 2021. When exactly those will be, nobody knows, because it's all down to vaccine rollouts and when people feel safe going out again. But make no mistake, there's a pent-up supply, and there will be a big blast, if you like, of theatre releases. And I think there's also a pent-up demand as well. People really want to get out. I mean, they're bored of sitting at home in lockdown. So once they feel safe to do so and they're allowed to, I think things will open up again. And obviously that will create a big surge, at least initially, for theatres. Eat and Play, this is just an example of one of the other things that they do. I could go through other slides showing you things that they do. For example, they have ski resorts, they have attractions, they have experiential lodgings, and so on. So it's not all theatres, but almost 50% is in the theatre industry. This slide here is an important one that I want to go through with you now. So the financial overview. So there's some important figures I want you to remember from this slide. So the liquidity available, they've got $1 billion cash on hand. That's what they had available. This is all for the 31st December 2020. Remember, this is what this report's reflecting on. So $1 billion cash on hand. Now remember that number, because when I come to a later slide, that's an important number. I'll refer back to that. Total capitalization, largely relevant as far as I'm concerned. 99% unsecured debt, that's good to know. Weighted average debt maturity of 5 years, and no debt matures until 2022. That means they've not got to pay anything back in 2021. They don't have to start paying anything back if they don't want to until 2022. 3.1 billion of debt is fixed rate or fixed through interest rate swaps, weighted average of 4.6%. The point there being they've borrowed the money cheaply and it's at a fixed rate, so they're not at the mercy of interest rate fluctuations like many other REITs are. They've paid down 23.8 million of senior notes, that's good, but what's much more impressive is they've also paid down 500 million on their 1 billion revolver balance, which now stands at just 90 million, which, you know, when you've got $1 billion cash on hand, 90 million is not a lot of money. So that leads us to their debt maturity ladder. And as you can see, nothing due in 2020, that's fine. Nothing due in 2021, that's great. Then they've got 90 million due in 2022. That is that revolving credit facility that we spoke about earlier. They've then got 400 million plus another 275 million due in 2023, and then in 2024 they've got another 136.6 million. If you add those years together, so 22, 23 and 24, that comes to 900 and something million dollars, which you will be aware is less than $1 billion, which is the cash they have on hand. So this company actually has enough cash on hand right now to be able to pay off all of its debts right up until 2025. not including 25, but including 2024. Okay, now that's obviously a cash-rich company, and that's not as a result of the cash being collected from rents. As we established, they're not doing great on the rent cash collections. It's improving, but it's certainly not how I would like to see it. You know, considering the high percentages of tenants that are open for business, apparently, why aren't they paying their rents? For me, that's a concern. I want that to be increased, and that's something I'm going to be keeping a close eye on. What they've done is they've made sales. So they've sold some of their properties, and I'm going to cover that in a second. So this slide here shows you the financial highlights, if you like, so you can see very clearly 2020 as compared to 2019. Now you'll see the total revenue was down. The second line on that is, I would say, probably the most important line for me anyway: net loss or income. You'll notice in 2019 it was a profit of $178.1 million. However, in 2020 it was a loss of $155.9 million. They made a loss. That is why they are not paying a dividend. Simple as that. You don't pay a dividend when you're making a loss. When it's making a profit, then it can pay a dividend. And in fact, as it's a REIT, it will have to pay a dividend as soon as it's making a profit. So what we're now interested in is what its future profits likely to be, because that'll let us figure out what its dividends are therefore likely to be. Now, the other things on this slide here, I'm personally not paying too much attention to. Everything you see with a little asterisk next to it is what is called non-GAAP, which basically means non-generally accepted accounting principles. So those numbers are not as solid from my perspective. And while everything is going on as it is in the world, I'm not putting too much emphasis on those. That said, I do like free cash flow, which is the FFO. That is something I normally do put a lot of emphasis on. But in this instance, while it's in this situation, I'm really just looking at its net income. That's my key thing. And if you want to be really precise, look at the net income per share, and you can see per share, it did indeed make a $2.05 loss per share. So this page here shows its deferral information. So non-deferral, 88 million. Sold properties, 25 million. So that made up 4%. Payments deferred and recognised as revenue during the deferral period, 231, which is 37%. Cash basis lease restructurings, 233, which makes up 37%. And then they've got new vacancies of 3%. Now a little capital markets update. So the net debt to gross assets was 40% as of the 31st of December 2020. That's actually really good. We like that. That's a low leverage. No problem with that at all. 3.7 billion total debt, 3.1 billion fixed rate, which as you can see is the majority of their debt, or fixed through initial rate swaps at a weighted average of 4.6%. That's very impressive. We like that. Weighted average debt maturity 5 years, no scheduled debt maturities until the revolver matures in 2022, which, as we've already discussed, they've got enough cash on hand to pay off in full, so that's nothing to worry about. During Q4, further amended bank credit facility and private placement notes to extend certain covenant waivers through December 2021. Liquidity position, 1 billion unrestricted cash on hand at the end of December 2020, which is absolutely fabulous, frankly, folks. I'm impressed with that. Positive operating cash flow in Q4. Operating cash flow expected to increase substantially in 2021. So that's a really good piece of news there. Whilst 2020 was a loss, the last quarter of 2020, they actually did have positive cash flow. That's a good sign. And they're saying they expect that in 2021, it will grow further, which is exactly what we want to be hearing. 550 million drawn on the 1 billion revolver, which is a credit facility. An additional 5 million then paid down, which leaves a balance now of 90 million. The paid down private placement notes by 23.8 million at the end of December, which leaves a balance of 316.2 million. And as we've established, they've got more than enough money on hand to pay that off. So where does all that leave us? What am I doing and what are my thoughts? Let me tell you now. My thoughts, basically, the current share price is fairly high, $45 per share. I'm going to go through some slides in a moment. If you remember my video that I made when EPR Properties cut their dividend, I'll put a link up there and in the description down below. In that video, I did make a number of forecasts. Actually, my best case scenario forecasting seems to be coming true at the moment. So kudos to me. I'm quite chuffed with that. But that's not necessarily going to continue. And I should point out at this point, I'm not a financial advisor, so this is not financial advice. Before you go buying any stocks or shares, you need to do your own research and due diligence. But I am going to let you know what prices I've bought at in the past, and I'm going to discuss the current price and where I think the share price is going. So let's have a look at my little spreadsheet now to see all of that. If you look at the spreadsheet, you've got a couple of possibilities. Now, this is an updated version of what I made as my best case scenario previously. Now, when I made that video previously, the current share price at that point in time was much lower than it is now. I should just chip in here and say my personal cost base average that I have this in two accounts, and in one account I've got it at $35 per share, and in the other account I've got a cost base average of $27.69 per share. I was buying this share all the way down from $35 down to $21 per share, and I can tell you now, when it went to $21 per share, I absolutely loaded the boat, and that's what pulled my average down, because I knew there was no way it was going bankrupt. In my opinion, I would be amazed. I went through this in the past. It had so much cash flow, cash on hand, it was going to be absolutely fine, and it had the ability to borrow more, and the management are excellent. And if you look at how they've managed this entire situation, I think credit to them, you can see that they're excellent. The fact they've got $1 billion cash on hand right now, which is enough to pay off all of the debt repayments for 2022, like not just the repayments, the entire debt balance in 2022 and 2023 and 2024. And we're just sitting at the beginning of 2021, having come out of a year where they made a loss. I think that says it all. That is seriously good management. We're talking about a very well managed company here in that respect. However, at this share price that we're looking at now on the screen, at $45.18 per share, am I keen to buy? No. Personally, I'm not. Should you be buying? That's entirely up to you. You really need to decide what kind of gains you want. And I'm going to go through the gains for two different possible outcomes now. And they're not the only outcomes, there are other outcomes. And to be fair, these are not the absolute best case outcomes. It could go a lot better than this. This is me being conservative, which is how I like to invest. I like to make sure I've got a really big upside and that my downside is covered. So if you look at these returns and you like these returns, do your own research, and if you agree with my thoughts, then it could well be an okay investment for you. Personally, I can find better ways to invest the money right now. The money I've got invested in this stock, I'm keeping in this stock, because personally, I've got a big chunk of money in there. I expect that it will continue to go up. I'm not concerned that the next few years won't be much of a percentage increase on what it is now, but I do believe that I will get really good dividends in the long run. And I'm someone who invests for the long term being minimum 5 years, usually more like 10, 20, 30 years out into the future. So if you're someone with a very short term horizon, don't even consider this. If you've got a long term horizon and you think that theatres are likely to be a thing of the future, people are going to be enjoying experiences, which I personally do think is the case for the future. I think the days of clutter and tut are gone. My birthday's coming up and people keep asking me, what do you want for your birthday? And honestly, I've got everything I want. It's, there isn't really anything I want. Maybe a massage. It's experiences. I want experiences now. And I think a lot of people are that way inclined. I've just noticed my monkey's on my notice board there. Sorry, I just want to speak quickly about my monkey, because someone put in the comments that my notice board's always blank and complained about that. I quite like minimalistic, clear. That's on the minimalistic thing. I think most people like minimalistic, but yeah, notice monkey is on the board. Drawing us some bananas over there. You see, he's doing his work. Normally, you don't see the monkey in my videos because the monkey sits outside my office door whilst I make the video so that my wife knows not to come in, because it's her way of knowing that I'm filming. But today, Teddy is sitting outside the office door instead of Monkey. Anyway, sorry, enough of that. Let's get on with the shares. EPR Properties, current price $45.18. Now then, if it gets back to its previous highs or near to its highs of $72, which is very realistic. If you watch my previous videos, this is a very realistic figure for the share price to go up to. And if the dividend is cut by 50%, so when it resumes, it comes at $2.30 per share, which is very probable. They're unlikely to come back at full strength, although they might come back at full strength. And if they do, then expect the share price to rocket. So if the dividend comes back at 50% of what it was, and by 2023, the share price has risen to $72 per share, you would have made a 59.4% gain on your capital, plus a 7.63% total earned from the income in dividends in that 2-year period, which would make an average of 33.52% return per year, which is pretty good return, quite frankly. Now, if it takes until 2025 for it to recover, which at the rate it's going, it's not looking like it's going to, but let's assume it does, then you would have still made a 59.4% gain on your capital. You would have then made a 17.82% return on dividends. Now, I've actually calculated this based on the dividends coming in the second half of 2021, because in the slides earlier we saw that's what was indicated in the earnings call, that's what they also indicated. They're intending to bring the dividends back, and they're intending to do it in the second half of 2021, subject to how the vaccine rollout goes and how things reopen, which obviously we all know will be staged and phased. Then you would have made an average of 19.31% per year total return. So that's your kind of best case scenario from my two possible outcomes. I have a much more conservative case, which is this case here, which is exactly the same again as I pointed out before in my previous video. So in this instance, the share price only gets up to $50 by 2023 or $50 by 2025, which obviously is looking extremely unlikely. We've almost touched $50 recently. I think it was up at $49 just a week ago. It's currently at $45.18 per share. So, this is, to say this is conservative, it's an understatement really, but let's go with it anyway. If you were to buy it and that was what happened, and I'm also cutting the dividend by 75%, so you're only getting $1.15 per share, which would make a dividend yield of just 2.55%, which frankly, if that was the case, that is not worth buying the stock for, just to be clear. Then you're looking at a gain of 10.66% gain on capital plus a 3.81% total earned in income if it takes until 2023, this is, which makes an average return of 7.24% per year. And if it took until 2025 to get up to the $50 mark, and of course them dividends came in at $1.15 per share in the late half of 2021, then you'd be looking at an average of a 4.89% return per year, which is not exactly exciting, and that's the reason why I wouldn't particularly be buying more right now. If you're not in this stock already and you want to get into this stock, I would maybe set a watch for it. If it drops under $40 per share, maybe consider buying it there. You could buy it now, that's fine, but just understand the upside isn't absolutely massive. And you only need something to go wrong with the vaccine rollout, theatres closed down, AMC to get in trouble, and this share price will fall. So there are a lot of risks still on the horizon that are potential risks. I say risks on the horizon, potential risks there, that things that could go wrong that could cause this share price to fall. So if you were someone that bought in at the $21 mark, like I bought loads at the $21 mark, you could consider cashing out now. There'd be no shame in that at all. But of course, there is still room for it to run. Personally, I'm a dividend investor. I'm buying it for the dividends because I believe they are going to come back. I believe in how this company is managed, and I do believe long run it will do very well. And certainly if you're someone looking to buy and hold for the next 20, 30 or 30 years, and actually today's share price is absolutely fine. The daily fluctuations almost don't matter to you. In all honesty, just remember, you're not going to be earning any dividend right now. And as they've not reinstated the dividend yet, you don't know how much the dividend is going to be. My hypothesis and best guess is that it will come in lower than it was previously, but of course I don't know that for an absolute fact. They've got plenty of cash on hand. If they wanted to reinstate it in full, they are more than capable of doing that, but the management are very cautious, so you do need to do your own research and make your own decision. Anyway, I hope you found that useful and interesting. Thank you so much for watching. Please leave me any comments in the description down below, and bye bye.